Now that we've finished going over the adjusted trial balances, we're ready to begin building the financial statements. Most corporations have 4 different financial statements that they use to show their information to their stakeholders. We're going to be looking at 3 of them. The first ones are the income statement and the statement of retained earnings, and we'll look at those in this video today. Let's begin with the income statement. Now, the income statement is something we looked at previously when we were talking about sole proprietorships last semester. So what does an income statement do? Well, as a reminder, the income statement tracks the money that's earned and spent during a year, and then what's left over when you're finished. So we're going to be covering what's called a multi-step income statement. So a multi-step income statement is similar to the income statement that we learned about in the last semester, but instead of just calculating the money earned, subtracting what we spent, and getting one total at the bottom, a multi-step income statement has multiple subtotals along the way until you get to net income at the bottom. That's why it's called multi-step, because there's several different steps or subtotals throughout the statement to get to the bottom number. And each one's important and each one provides some information that's helpful in analysis. So to help us with this multi-step income statement, I want to go over some of the basic terms of the categories that we'll be working with in this statement. Some of these will be a review from last semester, and some of them will be new. So the first one we have is revenue. Revenue is that money that is earned. So any money that we earn as a business goes in the category revenue. Last semester we had one account in there, sales. Sales is still the representative for the money that we've earned, but sales also now includes some contra accounts that will go along with it as part of revenue. Then we have our cost of goods sold. This one's new to this semester, but we've used it a couple of times before now. Cost of goods sold is the account category where we put all of our expenses related to our merchandise. So this will be things like the cost of goods sold account itself, as well as purchasing contra accounts. Then we have the operating expenses. Operating expenses are all of the expenses that are related to the normal operations of the business. So if you sit down and think about, okay, what does my business do and what kinds of expenses does it normally incur as part of doing its job? So for us, we're looking at merchandising or retail or wholesale businesses, and their big thing is buying and reselling merchandise. So what kinds of expenses are part of the normal operations of a business that does this? Well, you've got things like rent, or the salaries to your employees, utilities, repairs. All of these are examples of expenses that are normal to the regular operations of the business. Then you have things that are called non-operating items. These are the unusual or one-time purchases or expenses or revenues that aren't part of its normal operation. So a good example of this would be buying or selling equipment. So if I'm selling off used equipment, that's not part of my business. I'm not in the business of selling equipment. I'm in the business of selling my merchandise. So any equipment that I buy or sell, that would be outside of the normal operations. So that would be part of the non-operating items. Also, any kind of losses from disasters. If you had a flood in your area and your store got flooded. I had a client years back that had a warehouse that burnt down. That's an unusual thing. We don't normally have warehouses burnt down as part of our operations. That's kind of something that's a one-time thing. So those are all things that would belong in the non-operating items. Then at the very bottom, you also include your tax expenses outside of your normal operating expenses, and then net income, or what's left over. So after you've subtracted out all these different types of expenses, whatever's left over, that's your net income or your net loss if it's less than 0. So that's the different categories that we'll work with in a multi-step income statement. Let's take a look at how these work and what these different steps look like. As we begin building our income statement, we start by creating a header. And if you recall from last semester when we first built an income statement, the header begins with your company's name at the top. Then you list the name of the report. In this case, it's an income statement. Then you're going to list the year. Remember that for an income statement shows transactions that happen over a period of time. So we always list the period as part of the date. For purposes of this class, we'll be working with year-end financial statements. So we always start the date by saying for the year ended. and then give the ending date. That way, people know what period of time this particular statement is working with. So if we take those 3 steps, we can build a header for our income statement that looks like this: Your Company Incorporated, income statement for the year ended December 31st, 2020. Now we can start with our first category. Just like with a regular income statement, the first category that we have is revenue. And remember, revenue is going to include our sales account as well as any contra accounts. So for our example, we have returns and allowances. So we're going to take sales, subtract out returns and allowances, and that will give us our total revenues. So as you can see, total revenues is basically the same as net sales. It's your sales minus any contra accounts. Then we're going to create a section for our cost of goods sold. Remember that cost of goods sold are all of our merchandise-related expenses, so things like cost of goods sold and any purchase contra accounts. So in this case, our example, we're using purchase discounts. So we would subtract those contra accounts out of cost of goods sold, and that would give us our total cost of goods sold. So total cost of goods sold is your COGS minus any contra accounts. After you finish those 2 categories, we have our first step or subtotal in the statement. It's called gross profit. Your gross profit is just the net sales or total revenues minus total cost of goods sold. Gross profit tells us how much money we've earned just from selling the products. So just taking out the cost of the products themselves, what is our margin on these products? In this case, we sold product at $25,800 that cost us $9,700. So our margin on these is $16,100. That's the amount of money that we have to run our business on. The higher this number, the more efficient we are at buying low-cost items and selling them for higher. After we've finished our gross profit, the next step is to list all of our operating expenses. Remember, operating expenses are any expenses that are incurred as part of our normal operations of the business. Here are some examples of normal operating expenses: bad debt, depreciation, insurance, payroll, salaries, supplies. These are all things that are part of normal operations. Advertising, repairs, utilities, rent. These are all part of a normal operation of a business. Once we finish those, we can total our operating expenses. And then our operating income would be our next step or subtotal in this statement. Operating income is just your gross profit minus any operating expenses. The operating income is important because it shows us how much money our company earned this year as part of our normal operations. It doesn't include any of those weird, unusual, or one-time things like selling a big piece of equipment or having a warehouse burned down that can really throw off your year-to-year comparisons. It's really hard to compare this year to last year and see how well we did in our sales and as a business if we had a huge loss from a warehouse burning down or we got a huge gain from selling an asset. So if we only look at operating income from year to year, it gives us a pretty smooth and comparable number to see how much we're growing in our sales and efforts as a business year over year. So that's the purpose of operating income. And again, that's gross profit minus our operating expenses. Then, after we've done our operating income, we can add in all of the unusual or non-operating items like gain from a sale of an asset. We also include our taxes there. And then we total these as non-operating items. Now, paying taxes is, I guess, part of operating a business year to year, but it's not an expense that's considered part of your normal operations. You're not in the business to pay taxes. So most businesses pull that out, especially since that's something you have very little control over and can throw off your comparisons year over year, just depending on what the presidential administration does with the tax laws. So we usually keep that below in the non-operating. Then after we've totaled our non-operating items, we can get our net income. Now, one thing I failed to mention, that's why I put the arrow in there. When you're listing your non-operating items could be positive or negative. And so we don't we list those with signs. If the non-operating item is a credit balance, we list it as a positive number. If it's a debit balance, we list it as a negative number. So like our gain from a sale of an asset is positive, the income taxes we paid, that's a negative. So now that we've subtracted out the net or total non-operating items from our operating income, we get our net income. So net income is just your operating income plus or minus non-operating items. The net income at the very bottom tells us how much money the business gets to keep at the end of the day. But you can see that we've got all of these subtotals along the way, like total revenues, gross profit, operating income, and net income, that help break down each piece of earning this income. So we can analyze each piece one at a time and compare it to other businesses or other years within our business to see what areas are we growing and improving in. So as we look at net income, when we first learned about net income last semester with a sole proprietorship, net income was simply revenue minus expenses. And that's still true, but with a multi-step income statement, the expenses get blown out into separate categories. So the net income calculation gets a little muddier. It's really your net sales minus your cost of goods sold minus your operating expenses, plus or minus any non-operating items if there are any. So that's a little longer calculation, but it encompasses each of the different steps in our multi-step income statement. Now, one of the reasons that we have income statement and other types of financial statements is to help our stakeholders to be able to compare our company to other companies that they have a potential to invest in. To help with that, we have certain ratios that we normally calculate to compare two different businesses or two different periods together. One of those we learned about last semester when we were talking about sole proprietors. That was the return on sales. Return on sales is simply your net income divided by total revenue. And if you think about it, the name actually gives you the calculation. Return is another fancy way of saying our net income. Our net income is our return, or what we get returned back from the efforts of the business. So it's the return on top of the sales or total revenues. So return on sales, net income on top of total revenue. That's the calculation. So if we look at our business example and we take our net income, $11,951, divided by our total revenue, $25,800, then that gives us a return on sales of 46%. What that means is for every dollar that we earn in revenues, 46 cents gets to stay with the company at the end of the day. That's what's left over. That sounds like a pretty good number. Now, is it a great number? I don't know. Remember that ratios are only valuable if they're compared to something else. So we would need to compare this 46% to a previous year or to a different company in the same industry to see if we're really doing that well or not. Now we have another ratio that we want to look at for this semester, which is another common ratio for income statements, especially for merchandising companies, and that's the gross profit margin. Now that we have gross profit as part of our income statement, we can calculate the margin of our gross profit by taking gross profit divided by total revenue. So if I were to take my $16,100 in gross profit, divide that by my $25,800 in total revenue, that gives me a gross profit margin of 62%. What this means is when I sell a product, 62% of the sales stays with the company. The other 48% pays for the product itself. Now, most times, if you can get a gross profit margin that's over 50%, meaning over 50% of your revenues stay with you, your product costs less than half of what you're charging, that's a really good sign. That's a potential to be a profitable company. That means you have over 50% of the sales that gets to stay with the company to help pay for the company's costs. Now, again, anything over 50% is a good number. Is it great? I don't know. We'd have to compare it to a previous year or a different company to know whether or not this is a really good number, but anything over 50% is good. All right, so those are some of the ratios that we work with income statements. We'll look at a few others as we get to balance sheets. But for right now, let's take a look at a statement of retained earnings. This is new to corporations because corporations have the account called retained earnings. And the statement of retained earnings helps us understand basically where all of our net income is going. It tells us how much is given to owners and how much was left for the business for next year. This is important to stakeholders to know whether or not they're getting consistent returns back to them as owners, or to know how much is staying in the business to ensure that it can continue to grow and develop. So this report can be very handy. Just like with our income statement, it has a header at the top. It begins with your company's name, the report name, which in this case is Statement of Retained Earnings, and then the date, which again still has the period. So we say for the year ended December 31st, 2020. A statement of retained earnings begins by showing your retained earnings on January 1, at the very beginning of the year. This will be the retained earnings that shows up on your trial balance because we haven't closed anything at this point. So whatever is in retained earnings right now is what was there at the beginning of the year. So look at your trial balance, the adjusted trial balance, and get your retained earnings number, and that's what goes here. Then you're going to add in your net income and subtract your dividends. Remember, your net income's already been calculated for you on the income statement. That's why we start there as our first statement that we create when we're creating our financial statements. We do the income statement first, then we have the net income number to put into the statement of retained earnings. So grab that from your income statement and then subtract the dividends number that you found on your adjusted trial balance. The end result of that calculation is your ending retained earnings on December 31st, or at the end of the fiscal year. So again, your ending retained earnings at the end of the fiscal year is simply your beginning retained earnings plus any net incomes minus any dividends. And those are the first two financial statements that we use in most corporations.